Hi everyone, welcome back. My name is Valery Nikolaev and this is Financial Accounting. Today we're going to talk about income statement and how to construct it. Okay, so income statement measures the results of operations for a given company over a period of time. How well did the company do? That's the question that the income statement answers. And in the bottom of the income statement, we have something that's called net income. So that's the primary reason for income statement. Now, besides just telling us one number that's in the bottom, income statement provides us with a wealth of information of drivers behind this number. What exactly happened? That explains why net income went up or down, what were revenues and expenses, and so on. Right, so income statement comes with income statement equation that tells us that net income equals revenues minus expenses plus gains minus losses. Revenues and expenses tend to be repeated every period, right? These are called recurring items. Whereas gains and losses, they happen once in a while. They are called transitory items. We are going to focus, of course, mainly on revenues and expenses because these are the key drivers of the value the business is creating. So net income basically tells us about the change in shareholders' wealth over a period of time, or change in the value of shareholders' claim over a period of time. We can refer to net income as earnings, profits, bottom line, right? These are pretty much the same things. Okay, so let's take a look at an example of income statement, recent example by Apple. What do they have in their income statement? They in the top, they always have something that's called net sales, which is another way of saying revenue, right? So they have two types of revenue, product revenue and service revenue, and the total revenue, of course, is the sum of these two, right? Revenue tells us the value of products and services that they sold to customers, that they delivered to customers, okay? The second line item, important line item in the income statement is the cost of sales or cost of revenue. Sometimes it's called cost of goods sold, but this is for companies that sell goods, right? Service companies basically, don't have goods, of course, right? So cost of sales, it tells us about how much goods that we sold and services that we sold actually cost us as a company, right? And the difference is called gross margin. Okay, next item is operating expenses, right? Cost of sales is operating expense, but we also have research and development, and then sales, general, and administrative. So SG&A tells us about, compensation to the salespeople, to management, to lawyers, accountants, and so on, right? Administrative expenses, basically. And then when we take revenue minus COGS minus operating expenses, we get operating income, right? So that's perhaps one of the key items in the income statement. That's basically the core engine behind the value that the company is creating, right? Operating income. And below operating income, we have things like interest expense, which is here included into other income. We have sometimes interest revenue if we lend money, and we have interest or dividends that we earned if we made some investments. So these are sort of non-core type of revenues and expenses. And then we also have item that's called provision for income taxes, or basically income tax expense. Once we subtract these other things from operating income, we have net income, okay? And net income is used to determine earnings per share, which is basically net income divided by the number of shares outstanding, okay? Okay, now let's talk about sort of what's behind the numbers that you've seen in the income statement. How do we actually come up with it? How do we measure revenues? And how do we measure expenses? Conceptually, we can go about measurement of revenues and expenses in two very different ways. One is called cash basis, which is extremely simple. On the cash basis, we could basically measure revenue by basically counting how much cash we receive from customers every time we make a sale. And we would measure expenses by measuring how much cash we paid to suppliers of inventory, to employees, to tax authorities, and so on. Okay, so it turns out that conceptually it's not very appealing approach to measure revenue expenses because it introduces a lot of measurement problems, right? Income basically becomes quite distorted because we have so-called timing and matching problems. I mean, basic example is that in period 1 we purchase inventory, but we sell this inventory in period 2. So it seems like our performance was really bad in period 1 and as really good in period 2, right? That's the matching problem. So to address this, there's another approach that's called accrual basis. And accrual basis, the way it works is that we recognize revenues and expenses irrespective of cash receipts and payments, right? We recognize revenues and expenses when economic transactions happen as opposed to when we receive or pay cash. The idea behind accrual accounting is that instead of trying to calculate how much cash we actually received or paid, accrual accounting is trying to measure ultimate amount of cash that we generated in the current period, even if we haven't received it yet. Okay, and so accrual basis is conceptually much more compelling, and as a result, it is the approach that GAAP requires. GAAP does not allow cash basis. We talk about this just for illustrative purposes, but GAAP requires accrual basis, and this is what 99% of accounting is about. It's about accrual basis. Okay, so accrual basis comes with some basic principles, right? Basic 2 principles, revenue principle and matching principle. Revenue principle basically tells us when to recognize revenue, right? So it tells us that we have to recognize revenue in the period when we earn it, as opposed to in the period when we receive cash. And we earn revenue when we fulfill the promise that we made, right? When we basically deliver goods or deliver services, that's when we completed the process of earning revenue, right? And this is when revenue should be recorded. Now, when revenue is recorded, of course, it could be that we receive cash, but it could be also that we receive another asset, such as, a claim to receive cash, accounts receivable, right? So on the accrual basis, it doesn't have to be cash because that's what accrual principles are all about. Okay, matching principle is about expense recognition as opposed to revenue recognition, right? So it tells us that there should be a match between revenue and expenses when you think about recognizing expenses. That is, we should record expenses in the period when they generate revenues, right? So basically, expenses are recorded when we consume an economic resource, right? It could be we consume some asset, or we consume labor and acquire liability to pay for this labor as a result, right? But basically, we consume a resource in a given period, and this consumption generates a benefit of revenue, right? And so when we generate revenue, we also want to record expenses so that there is a match, right? Expense implies reduction in cash, but it could also imply a reduction in assets or increase in liabilities that you have to pay for the labor that you consumed, for example. Okay, so how are expenses and revenues defined under the accrual accounting basis? Revenues are defined as increases in assets or reductions in liabilities during a period of time in connection with delivering goods and providing services, right? So basically, when our operations generate assets or they reduce liabilities as a result of delivering goods and services, that's how we think of revenue. Conceptually, it tells us about the value of goods that we deliver, right, to our customers. And revenues tell us about, of course, conceptually increase in the value of shareholders' claim due to operating activities. such as delivering goods and rendering services. Expenses is the flip side of revenue. They are reductions in assets or increases in liabilities during a given period in connection with delivering goods and rendering services, right? So net assets go down basically when we recognize expense, and as a result shareholders' equity also goes down. It's intuitive because expenses keep track of reductions in shareholders' wealth, right? And they measure what is the cost of goods and services that we delivered in a given period. Okay, last time we talked about balance sheet accounts, and retained earnings is one of those. These are cumulative accounts. Besides balance sheet accounts, we also have income statement accounts, right? Income statement accounts are temporary accounts. They live only for one period of time, and then they are zeroed out, right? We don't literally wipe out the balances on those accounts. We simply transfer those balances to retained earnings account. And so every period, we start with zero balances on revenue and expense account, right? These are income statement accounts: revenue, expense accounts, gains and loss accounts, items that you see in the income statement. Okay, so revenue accounts increase by the credit side. And the reason for that is because all these credit balances tell us about increase in the value of shareholders' claim, which is retained earnings, and retained earnings go up by the credit side, being shareholders' equity account. Of course, for this reason, we also want to have revenues increase by the credit side, because all the credits to revenue accounts essentially are transferred to the credit side of retained earnings account in the end of the period. Expenses are the opposite. They increase by the debit side, and that's because retained earnings go down by the debit side, right? When expense is recorded, that means that shareholders' wealth is going down, and that means retained earnings have to go down, and that happens by debit side, and that's why expenses are recorded on the debit side of these T accounts, okay? And these debits from expense accounts, they are transferred to the debit side of retained earnings ultimately in the end of every period, right? So this gives you an idea how the income statement accounts work. Okay, so let's talk about the link between income statement and balance sheet. So every transaction that involves, income statement, every income statement transaction basically involves two accounts: one income statement account and one balance sheet account. So balance sheet account could be like cash, for example. When we record revenue, we could be receiving cash at the same time. But in most cases, we don't immediately receive cash. Cash either happens earlier or later, right? So for reasons, that cash under the accrual accounting, cash receipts and revenue recognition does not coincide. For this reason, we have 4 classes of balance sheet accounts that are going to be used in connection with income statement accounts to record the income statement transactions. Okay, these are accrued revenues and accrued expenses, deferred revenues and deferred expenses. Right? The word accrued means that we haven't yet received cash, but we have accrued the expense or revenue already, and that passed through the income statement. Deferred means that we have received cash or paid cash, but the item hasn't been yet reflected in the income statement, right? So this will become sort of more intuitive when we see how this works. So let's basically see how these accounts work to kind of understand what they do. Okay, so accrual accounting implies that revenue recognition and cash receipts do not coincide, and for this reason we are going to need 2 types of accounts, accrued revenue and deferred revenue, to deal with that problem. So for instance, we could have a situation when we earn revenue, say 10 over here, but we haven't received cash yet, right? So we have to book then accrued revenue. Okay, accrued revenue is a general label for an account, like, could be accounts receivable is a type of accrued revenue, interest receivable or dividends receivable would be another example of accrued revenue. Okay, so that's what would happen in the period 1 if we didn't receive cash, and then in period 2, when we actually receive $10, we would simply reduce this asset, right? Accounts receivable go down and cash goes up. Okay, so that's how accrued revenue works, right? It means that we have recognized revenue but have not received cash yet. That's what accrued basically means. Deferred is the other way around. Deferred happens is then when we receive cash, but we haven't earned it yet, right? So we cannot recognize revenue yet. We are recognizing a liability that we now either have to pay back 10 or do our part, right? And then in period 2, when we actually fulfill our promise, deferred revenue goes down and revenue goes up by 10. Right? So this is the mechanics behind accrued and deferred revenue accounts. Keep in mind that these are balance sheet accounts, not income statement accounts. Accrued revenue is an asset, deferred revenue is a liability. An example of deferred revenue could be advances from customers, for instance. Okay, it's also a general class. Accrued expenses and deferred expenses works in the same way. Sometimes we recognize an expense, of course, on the debit side, and we have not paid cash yet, right? So we are going to use accrued expense account. For instance, we, consumed labor, right? And now we benefited from it, and the question is, how do we account for it since we haven't paid it yet, right? Well, accrued expense allows us to deal with that situation. It allows us to record an expense today without receiving cash, and then when actual cash is paid, this expense, accrued expense, is going to be reversed, right? Accrued expense is a liability account on the balance sheet. Then we have deferred expense account, which happens when we make a payment but defer expense until the future, right? So we pay cash and we record an asset, right? An example of deferred expense could be a prepayment for inventory, right? An example of deferred expense is actually inventory, because inventory is going to be expensed ultimately, right? So that's all under the class of deferred expense. When actual expense is recorded, right, for instance, when we sold inventory, that's no longer an asset. We're going to reduce an asset and record an expense over here. Okay, so this gives you an idea of how accrual accounting works and implemented. Okay, so end of period adjustments is something that's necessary to talk about, because under cash accounting we wouldn't have these adjustments, but under accrual basis accounting we have something that GAAP requires accountants to do, and these are called adjusting entries, right? They happen in the end of every period, and the reason for why we have them is because two reasons. We basically, some transactions are not being recorded on a daily basis, right? They are not journalized. When I take a new notebook from a shelf, I'm not going to run and do, journal entry and so on, right? Some smaller type of insignificant transactions are counted for only in the end of the period. So we go and count how much supplies are remaining on the shelves, and then we make journal entry based on that. Another reason for why journal entries, adjusting entries are necessary is because some transactions are being triggered by the passage of time, right? So these are, of course, not cash transactions, but these are transactions such as, accrual of interest happens over time, right? Expiration of rent, expiration of insurance payments, depreciation of your property, right? These are all transactions that happen with the passage of time, and accrual basis requires that you record an adjusting entry in the end of the period to reflect that, so that your statements are in line with GAAP, right? Unadjusted balance sheet is basically not in line with GAAP, adjusted is in line with GAAP. After making all the income statement transactions and all adjusting entries, all we do is we take basically revenue and expense balances and transfer them to retained earnings account, right? As a result, retained earnings go up by the amount of net income. In case company generates a loss, right, this basically net income becomes negative and it's being moved to the debit side of retained earnings account, right? So that's as simple as that. Okay, so this is basically all I have about sort of conceptual overview of the income statement.